On January 28, the US stock market did something incredible, and then it just stopped. It hit a massive milestone only to completely freeze in its tracks. So today, we're going to break down exactly what happened, why it happened, and what it tells us about what's coming next. Let's dive in. Okay, so first, the big moment. On the morning of January 28th, 2026, the S&P 500 did something it has never, ever done before. It smashed right through the 7,000-point barrier. I mean, what a huge psychological win. A sign of incredible strength, right? Well, the celebration didn't last long. And that brings us to the central mystery of the day. After touching that historic high, why did all that momentum just vanish? How did the market slam on the brakes so hard that it ended the day going absolutely nowhere? The answer, when you dig into the source material, is actually surprisingly simple. The market's collective brain, from human traders to super-fast algorithms, came to one single powerful conclusion. Wait. It's like it looked at all the good news and all the bad news and just said, you know what? The smartest move right now is to do nothing at all. This massive indecision was basically a giant tug-of-war playing out in real time. On one end of the rope, you had this wild optimism, right, fueled by a revolution in technology. But on the other end, you had this deep, gnawing anxiety about policy, about profits, and about what the future really holds. And this slide, wow, this captures that paralysis perfectly. Just look at those daily changes. We're talking negative 0.01%, positive 0.17%, positive 0.02%. I mean, those are basically zero. After a day with a historic high, the market pretty much finished in a statistical tie. This is the very picture of a market holding its breath. So to really get this great divide, we need to look at the two key sectors that were pulling in completely opposite directions: the unstoppable force of the AI boom and the immovable object of a sudden crisis in healthcare. So, over in the tech world, it was all sunshine and rainbows. Companies like ASML and Texas Instruments were posting incredible results. It was proof that this whole AI boom is not only real, but it's spreading. But then you look over at healthcare, and a single government decision to freeze Medicare payments just sent this shockwave of fear through the entire sector. A move like that, it makes everyone question the future profits of some of the biggest companies out there. And if you want to see just how severe that shockwave was, look at this number. This was the one-day stock drop for UnitedHealth, an absolute giant in the industry, almost a 20% plunge in a single day. That kind of drop can single-handedly drag down an entire average and really crystallizes the fear in that part of the market. Okay, so with AI pushing everything up and healthcare pulling it all down, where can we look to see how the market truly feels deep down? Well, the source material points us to one place: gold, the ultimate safety net. Now, before we even see the price of gold, just look at the chaos investors were trying to process. The Fed suddenly hits pause on cutting rates. The S&P 500 hits this huge ceiling and bounces right off. Massive earnings reports from big tech are just hours away. AI is booming, and then, underneath all that noise, gold is quietly hitting a record high. It's a perfect storm of conflicting signals. And here it is. This is the result of all that uncertainty: a record-breaking price for a single ounce of gold. Let me tell you, when investors are nervous about politics, about the Fed, about whether the market has gone too far too fast, this is where they hide their money. This isn't a sign of optimism. This is a deep, fundamental demand for safety. You know, this phenomenon has a name. It's called the flight to safety. And that is exactly what we are seeing here. This record gold price is a direct mirror of the anxiety that's bubbling just beneath the surface. It's like investors were cheering the market's new highs with one hand while frantically hedging their bets with the other. So the big question is, what do you do in a market that's screaming both buy and run at the exact same time? Let's take a look at how the source material suggests we navigate this crossroads. The advice is pretty clear, cautious, and methodical. Step 1. Just wait. The earnings reports from Tesla, Meta, and Microsoft are going to give us real data, not just hype, so don't act on emotion. Step 2, protect yourself. The market's fear gauge, the VIX, is still pretty low, which means it's a cheaper time to buy some insurance for your portfolio. And step 3, have a plan. Decide right now how you're going to react to good news or bad news so you can act decisively, not impulsively, when it finally drops. You know, there's this famous quote that just perfectly sums up the core message here. While the excitement of seeing S&P 7,000 is tempting, this is a moment for discipline, not emotion. In a market this conflicted, managing your risk is absolutely everything. And so we end right back where we started, with a market holding its breath, waiting for answers. And it really all boils down to these three critical questions. Are the AI profits from big tech going to justify these sky-high stock prices? What is the Fed going to do next with interest rates? And will the threat of new tariffs actually become a reality? The answers to these questions will likely set the market's direction for months to come. So which of these are you watching most closely?